Welcome to the Beckonomics Podcast. I'm your host, Victor Beck, here alongside Hunter Beck, as we break down weekly market movements, macroeconomics, and what investors should be keying into as we look forward in this market environment. As a note, the topics discussed and opinions given are not intended to address the specific needs of any listener. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Beck Capital Management may maintain positions in the securities discussed in this podcast. Hey, Hunter. I think we've got an interesting topic for our listeners today, something that's on the minds of a lot of consumers. You want to go ahead and introduce us to our topic?
Well, thanks, Victor. So today we're talking about the housing market and how 2024, despite a lot of the headlines and articles suggesting otherwise, might actually be a really good time to buy a house. Mortgage rates are high right now, making housing affordability tough for a lot of people. But if we look out over the next few years, our logic starts to make some sense. We'll get into the details later, but right now there are fewer homes on the market. With the higher rates leads to a stronger buyer. So Victor, can you give us some of the background on where home prices are now and what generally impacts home price?
Yeah, absolutely. I think, going back to the core of it, homes are no different from any other commodity, anything that's going to have a price, right? It follows supply and demand, your traditional economics. So kind of stepping back a little bit, before the end of 2022, before the Fed started raising interest rates, you had extremely low interest rates coming basically since the global financial crisis, which really has driven a housing bull market, after we saw that kind of 08, 09 house price collapse. So those low interest rates, translate into a lower monthly payment for consumers whenever you're looking at mortgages. And so that allows people to buy, what's a more expensive home, or what really is just people paying a higher price for a home, translating into that lower monthly mortgage payment. Now that the Fed's kind of worked through their whole hiking campaign, we saw their Fed funds rate, as we've talked about before, go from 0% all the way up to 5.25% plus range. 30-year mortgage rates reached almost 8% at their peak, which scared away a ton of buyers from the market. No one's looking to buy a home necessarily whenever you're looking at an 8% mortgage. A lot of numbers that I saw around the cost of that monthly mortgage is going to cost almost double for the same price home under an 8% mortgage rate as it does, under 2-3% range that people were getting in kind of your COVID era. So what does that really mean? Potential sellers have been locked into those low mortgage rates. I mean, the term that I like is that, those are golden handcuffs. You've got a 2-3% mortgage on your home. Why the heck would you sell your house, buy a new one, only to get new financing at 8%? So that's really kept current homeowners out of the market as far as selling their home goes. And so new buyers don't have a lot of opportunities in the housing market. Now, kind of the other side of that piece is the fact that higher interest rates have actually helped decrease home prices to some extent because that affordability is lower. But, as we're going to kind of get into, builders are really going to be the source of that housing supply. So if current sellers aren't the supply, it has to come from somewhere. And so that's where we're going to get into the home builders and talk about them a little bit later. Because builders following the 2008 financial crisis, they pulled back really significantly on their supply. We saw that huge housing market collapse, and housing starts have not actually peaked again since the early 2000s. So you saw huge housing start peaks in the 1970s, huge peaks in the early 2000s. Since the global financial crisis, we still haven't set a new record high for housing starts. So Hunter, can you run us through, we're talking about, we started this episode off saying, hey, this could actually be a good time to buy a home. We just talked about all the reasons why it may not be. I mean, higher interest rates. Why the heck would you, potentially want to lock in a higher mortgage rate? Can you run us through some of the benefits potentially for home buyers in this elevated rate environment?
Yeah, exactly. So a lot of things are going to be kind of the inverse of what you're talking about in recent years with low interest rates, real high home prices. These higher mortgage rates, while in the immediate term make buying more costly than renting, it'll push prices lower, and in a few years, if mortgage rates come back down, then you can refinance and you paid less upfront and you're renting the rate, you're buying the house. There's also a lot of intangible benefits too for the buyer in this market environment. Over the past few years, kind of post-COVID or during COVID, we were seeing homes change hands at above asking in a matter of days. And so now the time that homes are on the market is starting to increase, allowing buyers to take their time more, have more bargaining power, as well as take the time to do all of the pre-purchase inspection, lay their eyes on it, and you're not buying homes sight unseen like we were seeing during COVID.
Yeah, Hunter, absolutely. I think obviously we're in a hot market here in Austin, but you were seeing some pretty incredible things during that COVID period. People, we had all sorts of people from out of state moving, and this was really a Texas-wide phenomenon, but especially here in Austin. You were seeing people offering cash 20% above asking and sometimes not even getting the house. I mean, these people had no options when it came to, hey, am I going to make sure everything's working properly and make sure the home is, structurally sound? As you were mentioning about the inspection, some people were totally waiving inspections. They weren't even necessarily making sure that this was a hospitable home or that they were going to have a whole lot of things to fix. So, somewhat unique to the city that we live in, but this was kind of a nationwide phenomenon as people during COVID wanted to move, more into suburbs, more into housing outside of the cities. And it drove up those home prices, but created a really tough environment for home buyers.
Exactly. And so now we see these pressures easing and people can get back to the more normal flow of how home buying should be. So that's all good and dandy, but why now? Why is now a good time? Well, we're at the end of the interest rate hiking cycle. And while we're still going to be in a sustained high interest rate environment, and we're not going to get back into that 2 to 3% range anytime soon, interest rates are moving downwards, and there's a good likelihood that over the next few years, there will be some attractive rates that you can refinance back into.
Yeah, I think that's the benefit of the financing piece of that, is that even though you may be paying higher financing costs now, you have these, as you mentioned, the intangible benefits where you can look at a home, you can make sure it's somewhere you want to live, you don't have to jump into a buying decision. And then, yeah, sure, maybe, you finance a slightly higher cost, but then, inevitably whenever interest rates, fall sometime in the future, you can refinance that mortgage, get that kind of, monthly payment that a lot of consumers are more concerned about.
Exactly. And we'll get into it in just a minute here, but another great option in this environment is new homes. New homes are coming on the market. They're on the expensive side, yes, but counterbalancing that to make these appeal to people, home builders are buying down the interest rates for the first few years. And so you have cheaper interest rates for years 1 through 3, depending on the home builder. And then it goes back up to that 6-7% range that we're looking at right now in the market. However, in 2 or 3 years, maybe 4 years, you'll have that optionality to refinance back down. So you might be able to get those first few years of cushion and then roll right into a refinance before you even have to pay that higher rate. So Victor, now that I introduced the concept, you want to take us through the home builders?
Yeah, absolutely. I mean, this is an investing podcast after all, is it not?
Exactly. So let's get to some investing.
Yeah, so from our perspective, home builders are a great opportunity in the market right now, just because, as we mentioned, they are the a major source of housing. Like we said, current owners are kind of have those golden handcuffs. They're tied into those mortgages. And so the supply is coming from this home builders. So they have seen a huge boon from this tight supply and demand market. And as you mentioned, Hunter, they can really work that financing for their clients, for the buyers of their homes. So they're able to get people that attractive mortgage rate for a few years, give them a new home, and then, build that inventory that at the end of the day makes them money. There's still a high demand for homes too. I mean, I kind of mentioned this at the beginning of the podcast, but there's a huge gap between, and this has been the case for quite a while, there's a huge gap between household formations in the US and the number of homes that are available. A lot of that demand has been satisfied by multifamily housing. So thinking, apartments, condos, but there are not nearly as many homes out there as what are demanded by the US consumer. So home builders have a great opportunity to kind of bridge this gap, and they're really starting to uptick how many homes that they're working on, how many homes they're building because of the tightness of the market and the demand that they have for homes. And they also, it goes back to the supply demand dynamic, your economics 101. Due to that lack of supply, they have pricing power. So even if they have to work the financing a little bit, and that's going to cost them a little bit of margin there, they're able to get pretty attractive prices on those new homes because they don't have that competition from existing homes because those buyers are locked in, or those owners are locked in, excuse me. So Hunter, going to the equity piece, can you run us through, from a kind of high level, just home builders across the board? I don't think we'll call out any specifically, but can you kind of tell us what this has meant for home builder equities?
Yeah, so if we just look at the index level, XHB being the S&P Spider Home Builders ETF, that advanced 44.5% over the last year, which is far beyond what the S&P did. That's into some magnificent 8 territory right there. Even after that huge advance, that ETF only has a price to earnings ratio of almost 16 times, which is still below their historical average. So they've made huge movements in price, but they're still relatively cheap. That's something that we get into a lot with some of those Magnificent Seven. When your earnings are growing so fast, your price can go up a lot, but you're still on a PE basis cheaper than you were yesterday or at the beginning of the year before your 44.5% run. And even on top of that, as inflation's come down and we've seen lower energy prices and moderation and deflation through materials, your input costs are going down. And now that your supply chain has normalized from those COVID shocks, these home builders are finally in a position where they can consistently build, plan better for their home projects, and are just all in all in a better operational environment.
Yeah, I think that was kind of the frustration during COVID was there was that demand for homes, like we said, but the only supply was really existing homes because these home builders just straight up couldn't get the supplies that they needed to build homes. And if they could, it was extremely expensive. So it was pretty cost prohibitive, during the pandemic era, tight supply chains to build new housing. But now they have an opportunity to do it at much lower input costs. So, supporting your margins pretty significantly there.
Yeah, no, Victor, exactly right. So I think we've covered that basis pretty well. Do you want to wrap us up?
Yeah, absolutely. And as a reminder to our listeners, individual circumstances vary. It may or may not be the right time to buy a home depending on any individual circumstances. And that's why, we have a financial advising business, to answer questions exactly like that. But, we see that the home building space has a very positive outlook for the year, even coming off of those huge returns, Hunter, like you said, over, 2023. Valuations still look attractive. Those home builders could be a really good area of interest. And then, kind of last note, if you're a seller, I think, if you're upsizing your house, like we said, kind of a good opportunity to buy now. That's a higher cost home. Might be a good time to do it. If you're downsizing, you might want to wait until the market gets tight again, becomes a seller's market. Thinking about these things from both sides of the transaction, of course. Well, I think this is an interesting topic on the minds of a lot of consumers, and I'm glad we had the opportunity to give it a quick rundown for everybody.
Yeah, thanks, Victor, and thank you all for listening to another episode of the Beckonomics Podcast.